It's Sunday Business with Andrew Patterson.
And it is coming up 24 minutes to 12. Well, as investors and fund managers get set to close the books on another year, there are mixed views on what might be in store for the global economy in 2015, and a year that's seen market sentiment swing wildly between bouts of extreme optimism brought on by cheap money and low inflation. In recent weeks, since we've been speaking about with Chris, the pendulum has begun to swing back the other way as crude oil prices continue to sink like a stone, now trading well below $60 a barrel for the first time in more than 5 years, when prices crashed at the height of the global financial crisis. Good news for motorists perhaps, but does this potentially spell trouble for the wider economy? And this week, as we've also mentioned, New Zealand took a financial hit of its own. Yet another cut in the forecast payout to farmers, revised down to $4.70 a kilo of milk solids, potentially impacting GDP by as much as 2% next year. Yet for property investors, it's almost the perfect scenario. Rising prices and falling interest rates for fixed-term mortgages. It's no wonder investors continue to seek safety in bricks and mortar. So what are investors to make of all of this, and what might be some of the market risks to consider in 2015? Joining me in the studio this morning, Greg Peacock, Chief Investment Officer at New Zealand Asset Management. Established in 1991, NZAM is an award-winning independent global investment management company servicing private and institutional investors throughout New Zealand, Australia and Asia who seek absolute or positive returns each year. Welcome, Greg.
Thanks.
Welcome. And let's start with your overall assessment of 2014 from an investment perspective. I mean, as far as equities go, returns were more muted this year than previously, perhaps more single than double digits. How has the year concluded compared to your expectations at the start of the year?
Well, I think equity markets have done essentially, if you just look at the headline numbers, roughly what pundits were predicting this time a year ago. The big surprises really have been the oil price, as we've been talking about, and the collapse in bond yields. In an environment where the US is getting towards the end of QE and has in fact just stopped it. The expectation, I think, was that bond yields would rise, and in fact they've headed in the other direction in a pretty dramatic fashion.
So therefore, it's left us in this, well, for some it's been a sweet spot, hasn't it? But there is this sense that maybe we're about to start a new chapter, that the end of the golden weather is beginning to come to an end. When we think of the US particularly, is the Fed going to have to move on hiking rates in 2015? Is that a certainty? Is that baked in?
No, it's not quite baked in. So QE has finished, and the expectation going into this year that would happen at some stage, and it's happened in a sort of a staged fashion through till the month of November when it actually stopped. The next stage is rate hikes. Now, we've never been in a situation before where we've had QE, so the exit process is all new. It's new to the Fed, it's new to the markets. So, predicting it with any degree of certainty is difficult, and it's going to depend on how the economy performs. If the US economy remains firm, we will get rate hikes at some point next year.
What will be the implications of that, do you think?
Well, again, we're in a situation where no one really knows. If I think you can make the argument that a lot of the equity market strength in the past, well, really since 2009, has coincided with QE. It's been supported by QE, by the liquidity it's created. The market rally has been long in terms of time. It's been long in terms of appreciation, and so if QE has been the rocket fuel, if you like, and that has now stopped, certainly it's going to be more challenging, I think, for equities going forward.
And that does, I guess, create a dilemma for investors. And well, firstly, let's talk about that sweet spot itself. I mean, has it lasted longer than you expected? Has it, because there was, when we think back to, those critical points in 2008, 2009, when we were, right at that point of despair. And now we almost seem to be at the other end of the curve, where we think that this could just go on for and ever and ever. Has that surprised you?
Yeah, I think so. So if you go back, if you look at this bull market which started in 2009, it's about 5 years old, and there have only been 3 other bull markets in the US since 1928 that have lasted this long. Now, they ended in Black Monday of 87, in the tech wreck of 2000, and in the GFC. So that just suggests that, that the risks are certainly rising. Doesn't mean we're about to fall off the edge of a cliff tomorrow, but it does mean, I think, that investors need to be cognizant of the fact that, it is late. It is late in the game.
If we think of the three players, you've got the market, you've got central banks, and you've got investors. The investors are believing in central banks, and the markets are believing in central banks to support them. So everybody's lined up at the moment. So what you're suggesting is the next stage is when one of those loses faith.
Possibly. So I think if you go back to the Asia crisis and the LTCM event in the late 90s, every time markets have tripped, central banks have stepped in to support the markets. And the market's woken up to that. It understands that, and there is
classic moral hazard.
Yeah, absolutely. And the central banks, particularly the Fed, perhaps less so Europe, believe, I think, that they have the ability to underwrite, market collapses. And so there's no doubt that the next time markets look shaky, the Fed will step in again. And so exactly as you say, Andrew, there's this moral hazard issue that it works until it doesn't. And, perhaps it'll work next time, perhaps it'll work the time after, but, eventually it perhaps we'll find out the emperor's got no clothes.
How much more capacity do central banks to have just to keep printing infinitum?
Well, I think that's one of the arguments for the Fed unwinding its QE program and looking to raise rates to effectively, reload so that they've got the capacity to do more next time. It's interesting to see the difference between the US approach and the European approach. The Europeans have been remarkably slow to move, and I think that's because the ECB in Europe is dominated by the Bundesbank, and the defining event for the Bundesbank was hyperinflation in the 20s. So their instinct is always to fight inflation. In the Fed, the defining event was the depression of the 30s. So there's always this preparedness of the US authorities to try and avert economic slowdown.
Let's talk about oil, because it is very much front and centre at the moment, and this has been the really unexpected part of 2000. I don't think. Did you read anybody picking the oil price this year to end up under $60 a barrel?
I'm struggling to recall anyone who was predicting oil prices lower at all, let alone down 40% or whatever they are. It's remarkable.
So is this really a battle of the political titans? This is OPEC versus the US versus Russia.
Yeah, I think so. So in terms of the world economy, it's a zero-sum event because the producers are getting less revenue, but the consumers of the world and the corporates are getting what amounts to a very large tax cut effectively. So it's positive in that respect, but there's a huge deflationary impulse that it creates, which again is going to challenge the Fed, because if you have stronger growth as a result of this tax cut and lower inflation, is that an environment you ought to be raising rates? It's a conundrum for them. But as you say, there's certainly there's a geopolitical element to what's happening in oil as well. So the major loser really is Russia. And so, I think for the US, lower oil prices are tolerated here because of that. And I think Saudi Arabia as well sees an opportunity to perhaps gain market share versus some of the higher cost producers.
Talk a bit about China, because the numbers have been very soft out of China in the last few months. China is slowing and continues to slow. How much more can it slow before it really begins to inflict some damage on the global economy?
Yeah, well, I think slowing was, to some extent anyway, was inevitable. It becomes the law of large numbers. If the second largest economy can't grow at 10% per annum ad infinitum, looking forward from here, I think Churchill said about Russia that it's a riddle wrapped in a mystery inside an enigma. And I kind of feel like China's like that for global investors. It's very, very difficult with Western eyes to have a great deal of confidence about what's happening there.
And if we think about, bring it back to New Zealand, we've had, 60% return on the NZX50 over the last 3 years. It's been a great run for New Zealand investors. When you're looking at your investment decisions for next year, how much of the fund have you got in New Zealand, and how much do you think we're at much, obviously perhaps at the top end of that risk curve a little bit now ourselves?
Well, we have nothing in New Zealand at all, Andrew, and there's really two reasons for that. Firstly, that our clients come to us for global exposure, and secondly, I think that we employ what we call an absolute return philosophy, and that requires managers to be very active and also to be able to hedge when necessary. And the New Zealand market doesn't support that style of management.
It's not big enough for the sort of fund that you're running.
Not big enough. That's right. Yeah.
And so where are your assets mainly based?
So our approach is primarily that we want to invest in manager skill. And so we invest essentially where we can find that, rather than where we think the best market prospects are. And I think a really great illustration of that has been for us in Europe over the past few years, where, as we were mentioning earlier, Europe's really performed dreadfully. But our equity managers based in Europe have performed better than they have in any other region of the world. And I think that's because, Europe has created a winners and losers situation for corporates. And skilled, high-quality managers have found opportunities there.
Yeah, well, that's the ultimate test, isn't it? And they'll be getting a bonus, no doubt, because anybody that's made money in Europe would be doing particularly well in this environment. So where does this leave you? I guess next year, when you're thinking about where you're going to be allocating money. What are the broader risks that you think investors should be considering and taking into stock next year themselves? And where will you be thinking about where the potential is risks for your own funds?
Well, I think for investors, the conundrum really is that equity markets globally, and you could include New Zealand just as well in this debate. Equity markets are expensive. If you compare them with bond yields, they're probably fair, but bond yields are almost unnaturally low at the moment. So the issue is if equities are expensive and bonds can't support, investors, particularly with their yields going forward, how do you build a portfolio? And our approach really is that you need to have skilled managers. And that's a challenge for New Zealanders investing globally. I think we'd all be a little sceptical of a New Zealand manager based in Oslo, for example. I think we've got to figure there's people in New Zealand that are capable of doing a better job in New Zealand than offshore. So if you're looking to invest offshore, we think you need skilled managers based in those markets, rather than trying to do it yourself in New Zealand. That's a pretty tough ask.
If we think to from here in terms of I guess specifically around the New Zealand domestic situation with the lower payout from Fonterra and the fact that New Zealand could be buffeted. I mean, notwithstanding the fact that you don't have any specific investment in New Zealand, what is your view at the moment, I guess, from the risk potential for New Zealand in 2015? Well,
I think one of the really interesting things is the currency. So the currency ought to be the buffer, if you like. Lower commodity prices ought to be associated with lower currency prices, the lower currency to offset that to a degree. And really, other than against the US dollar, the New Zealand dollar hasn't weakened in the past 6 months.
Yeah, in fact, we spoke earlier on the program that on a trade-weighted basis, it's actually up.
Yeah, which is kind of remarkable. So we're seeing a strong US dollar rather than a weak New Zealand dollar, and this is clearly a conundrum for the RBNZ. They would like a lower New Zealand dollar. It's interesting, the Australians had the same issue a couple of years ago, and the currency seemed to defy gravity for a period of time and has subsequently weakened, and I think that is likely in New Zealand.
And of course you do have this, as you say, conundrum where the RBNZ could cut to achieve a lower rate. But of course, you've got the property market sitting on the other side. How much do you believe the property market is potentially a risk area as well too next year?
Look, I think if you were looking at property values versus incomes, I mean, you could have predicted a decline at any stage in the past decade in New Zealand, and it hasn't happened. So the interesting thing as a global investor is that, you know, New Zealand property is kind of the inverse of what's happening in markets around the world. You know, the global markets are suffering through a lack of demand. It seems like the problem in property in New Zealand is a lack of supply.
And that, of course, is creating the problem at the moment. When does it become a bubble? Because there has been talk about this. I mean, when, you know, specifically, is that a risk area at the moment, do you think? Look,
I think, you know, bubbles by their nature are easy to detect with hindsight, and even if you're aware that you're in one, predicting the end of it in a timing sense is particularly difficult. And you know, I think Keynes once made the comment that you know, you have to be able to remain liquid for long enough to be able to enjoy the fruits of your intelligence when you get proven right. And look, betting against New Zealand property has been a pretty tough thing to do.
It has, and it's been a loser's game to this particular point, hasn't it?
Yeah, no question.
So I guess just wrapping up, when we think about 2015, and so we're going to potentially see the US hiking rates. We'll see probably no change next year in the interest rate outlook here, according to the RBNZ's outline that this week we've got the potential for equities to be hitting the top of the risk curve. Where does that leave us generally? I guess anything else in terms of the commodity space that would be catching your attention at the moment?
Yeah, look, I just think it's a time, you know, it's very easy to make investment decisions looking backwards, and if you do so, you know, equities look fabulous. Looking forward, I think, you know, we could easily have another year of, you know, 5 to 10% returns. That's entirely feasible, but I think the tailwind is ebbing. And therefore risks are rising. And that's simply because of the maturity of the bull run itself. Yeah, it's the maturity of the market, and also the fact that, you know, if you do subscribe to the view that the Fed has been supplying the punch for the party, the punch bowl is empty. Yeah, QE has finished. Yes, and we could be in the early stage of a whole new scenario for 2015. Appreciate you joining us today. Thanks for your time. Speaking to Greg Peacock, Chief Investment Manager at New Zealand Asset Management. They are an independent global investment management company. They service private and institutional investors throughout New Zealand, Australia and Asia, although, as you heard, no specific stake in the New Zealand market at this point. It's coming up 5 to 12 on Sunday Business.